Hello everyone, welcome to FinTalks. This is Dr. Harikarri, PhD in Finance, having 22 years of experience in teaching and industry. I worked in one of the accounting and auditing firm Deloitte in US taxation services, and due to my passion towards teaching, I left Deloitte and continuing as a faculty of accounting in finance. Based on my experience in teaching and also industry, and also after discussing with few of my colleagues and friends from the industry, I prepared a list of questions which are useful for the accounting and finance related job interviews. So in this video, I am going to explain in detail along with the answers in a simple and easily understandable manner a few of the accounting and finance interview questions. Let us start. The first one is, what is an accounting cycle or accounting trail? So what is accounting cycle means the whole process of accounting is called as accounting cycle. So the order in which accounting process flows is called as accounting cycle or accounting trail. It is a step-by-step process in the accounting in order to achieve the goals and objectives of the accounting. So basically the accounting process starts with the identifying a transaction. Whenever a transaction takes place in a business, that is financial transaction takes place in a business, first the transaction has to be identified. The transaction will be identified with the help of a source document, that is like a vouchers, bills, receipts, notes, etc. And after identifying the transaction, then the transaction has to be measured in terms of money. It has to be measured in terms of that local country's currency. After measuring, the next step is recording. The transaction will be recorded in a book called as journal. So recording of transactions in a book journal called is journalizing. And the book in which they are recorded is called journal, and the way of recording is called as journalizing. Different types of journals which are recorded for used for recording are like a cash book, purchase book, sales book, etc. After recording of journal entries, the next posting them to the ledger. In the ledger, different types of individual accounts will be there, and from journal, the entries will be posted to their concerned ledger accounts. So the transfer of entries from journal to ledger is called as posting. After posting, the next step in accounting process is summarizing. Summarizing means preparing the trial balance, trading and profit and loss account, and balance sheet is called as summarizing. After summarizing, the next step is analyzing and interpretation. Inform, 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 Information available in financial statements so that make the judgment way. After analysis, the last step is communication. Communicating these financial statements to various users. There may be internal users or maybe external users. Internal users like internal management, employees, and external users like creditors, banks, loans, government, etc. So this whole process, identifying a transaction, measuring a transaction, measurement in terms of money, then recording, then classifying, summarizing, analyzing and interpretation, and finally communicating. This whole process, the flow of process step by step is called as accounting cycle or accounting trail. So this is one of the important question asked in number of interviews. What is accounting cycle? And the next one is another important is, what are the three main types of accounts in accounting? Basically, the three main types of accounts in accounting are personal account, real account, and nominal account. So this understanding these three types of account is very very important for recording of the transactions in entries. So what are the real accounts? Real accounts means all the accounts related to assets of the firm, whether they are tangible assets or intangible assets. All the assets will come under this category of real accounts. Tangible assets means tangible real accounts which we can see and touch. That is, which you can feel them physically. Their building, machinery, stock, etc. will come under tangible real account, tangible assets. And intangible assets will come under intangible real accounts. They are like a which we cannot see or which we cannot feel and we cannot touch. They are goodwill, patents, trademarks, etc. So this real account is used to record transactions related to the assets, that is tangible and intangible assets. The first one of the category of the assets is real accounts, and another category is personal account. This personal account is used to record the transactions related to persons. Either there may be or 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 there may be artificial persons or there may be representative personal accounts. Personal account is used to record accounts transactions related to persons. Here the persons are classified into three categories. Natural persons, people like us, Krishna, Hari, Subhash, Rahman, Juvaina, etc. Natural persons. Artificial persons. Artificial persons created by law, created by an act. That is Reliance account, HDFC account, ICICI account, so XYZ company account, ABC LLC account, like that. They are called as artificial persons. And the third category is representative personal accounts, that also recorded under these personal accounts only. What is representative personal account means? Like outstanding expenses, expenses which are due, not paid. For example, outstanding rent. Rent is due to whom? Due to a owner, landlord. Here owner is a, landlord is a person, natural person. So here this outstanding rent is indirectly representing a person, representing a natural person or artificial person. That's why they called as representative personal accounts. Another example, prepaid insurance. Prepaid insurance means insurance is paid in advance. To whom we paid? Insurance is prepaid to an insurance company. Here insurance company is a artificial person. It is indirectly representing a person. So that's why this is also called as a representative personal account. So personal account is used to record different types of persons, transactions related to natural persons, artificial persons, and representative personal accounts. And the third type of the account is a nominal account. This account is used to record all the transactions related to expenses, losses, incomes, and gains. So the examples are salary account, purchase account, sales account, commission receipt account. These are the accounts which are used to record the nominal accounts. So the three types of accounts are personal account, real account, and nominal account. Personal account is used to record accounts of the various persons, that is natural person, artificial person, or representative personal account. Real account is used to record the assets, transactions related to assets, that is it may be a tangible asset or intangible assets. And nominal account is used to record the transactions related to transactions involving expenses, losses, incomes, and gains. So these are the three types of the accounts. And the next another question is, what are the three golden rules of accounting? So the three golden rules of accounting is classified based on the three types of account. Three types of account, three rules of accounts are there. So what is the rules of accounting? The personal account rule is rule is debit the receiver, credit the giver. If the person is receiving, then his account will be debited. If the person is giving, his account will be credited. And real account, which is related to the assets. And the real rule of the real account is debit what comes in, credit what goes out. If the asset is coming into the business, its account will be debited. If the asset is going out of the business, its account will be credited. And the third account rule is related to the nominal account. The rule of nominal account is debit expenses and losses, credit all incomes and gains. If they are expense and losses, their account will be debited. If they are incomes and gains and revenues, their account will be credited. So based on there are three rule accounts. There are three rules of accounts are there. And for the rule of personal account is debit the receiver, credit the giver. The rule of real account is debit what comes in, credit what goes out. And the rule of nominal account is debit all expenses and losses, credit all incomes and gains. And it is very compulsory to know these rules of accounting to start the accounting process, to start the double entry bookkeeping system. It is the very most important thing. These are also called as traditional rules of accounting, or this is also debit and credit. Rules of debit and credit are they called as golden rules of accounting, golden rules of double entry system. So we can call them as a golden rules of double entry system, or rules of accounting, or rules of debit and credit. And it is compulsory to have knowledge about these rules of accounting before starts accounting process. For example, purchase furniture for cash by paying 1/10 cash of 10,000 rupees. The two accounts involved are one is furniture account and the other one is cash account. It is not purchase account. Purchase account is only for purchase of goods. Here there is a furniture asset is purchased. So the two accounts are asset account, furniture account, and the other one account is cash account. So the rule is with the following the real account is debit what comes in, credit what goes out. When you purchase furniture, purchase is coming into the business and cash is going out of the business. So since the furniture is coming into the business, furniture account will be debited. Since the cash is going out of the business, cash account will be credited. So furniture account debit to cash account credit. So in this way, we will record the journal entries by understanding the rule of debit and credit. These are the three rules of the accounting, or rules of double entry system, or golden rules of accounting. And next, another question is, what is accounting equation? It is also called as accounting equation, or it is also called as balance sheet equation. What is accounting equation? Simple. Assets equal to capital plus liabilities. Total of assets is always equal to total plus liabilities. How they are equal? It comes from the concept of dual concept of accounting. According to dual accounting, every financial transaction takes place in the business will involve minimum two aspects. It will have two aspects. One aspect is debit, the other aspect is credit. And always, debit is always equal to credit. For every debit, there is equal and opposite corresponding credit. So that's why assets are always equal to capital plus liabilities. Sources of funds are always equal to uses of funds, application of funds. So here capital and liability means sources of funds. From the business is getting funds through capital and liability. This is sources of funds. And application of funds means assets. Use of funds means assets. We are using our funds through assets. So that's why sources are always equal to uses and application. That's why in such a way, based on the dual aspect, based on the dual concept of accounting, this equation is framed. Assets are always equal to capital plus liability. This is called as an accounting equation, or it is also called as a balance sheet equation. This equation explains the relationship between the three variable assets, capital, and liability. Another important question is, what is the difference between direct and indirect expenses? The expenses which are completely related to are assigned to the core business operations. If your business operation is production, it is completely related to production. If your business is trading, it is completely related to trading. That means buying and selling of goods or services. That expenses are called as direct expenses. So the expenses which are completely related are assigned to the core operations of the business, either it is a production or it is a trading, whatever may be. If it is completely related to the assigned to this core operations, business operation, it is called as direct expenses. For example, wages, factory rent, anything related as production will take place in the factory. So anything related to factory will be a direct expenses, or you can call it as fuel, freight, carriage inwards. These are all called as direct expenses. These are directly involved in the production or directly involved in the trading of the goods or services of the business operations. And these expenses, direct expenses, will appear on the debit side of the trading account. Indirect expenses, the expenses which are not directly related to, not directly assigned to the core business operations, not directly assigned to the production or trading, that is goods and services, that is called as indirect expenses. These expenses are necessary, compulsory to keep the business moving, to keep the operations running. These expenses are helpful to move the business, to run the operation smoothly, but they are not directly related to the core operations. They are called as indirect expenses. Example, salaries, printing and stationery, telephone bill, legal charges, carriage outwards, etc. So direct expenses means the expenses which are directly, completely related to or assigned to the core business operations, either it may be production or trading. The expenses which are not directly assigned or related to the core business operations, they are called as indirect expenses, and these are the expenses necessary to keep the business running, to keep the business moving, but they are not directly related to the cost production. They are called as indirect expenses, and these indirect expenses will appear on the debit side of the income statement, that is profit and loss account. So this is the difference between the direct and indirect expenses. The next one is, what is trade discount and cash discount? Generally, when we are as a part of business operations, it is general to receive the discount, and discount will be two categories: trade discount and cash discount. So trade discount is generally, it is happened due to trade practices. It is trade practices are when you purchase in a large quantity, happen in the business to receive some trade discount. So trade discount means it is a reduction granted by a supplier on the list price or catalog price. So whatever the deduction, for example, ours is a business enterprise, we purchase goods from the supplier. So when you purchase goods from the supplier, whatever the reduction given by the supplier from the catalog price or list price, that reduction is called as trade discount. And giving trade discount is a generally trade practice, and it will happen when you purchase in large quantity. It is general to give the trade discount, and this trade discount is not shown separately in the books of accounts. It will not appear in the books of accounts. Here the transactions are recorded net of the trade discount, net of the trade discount. So this trade discount will not appear in the purchase or sales books. For example, you purchased or you sold 100 keyboards for the list price of 300 each with a trade discount of 10%. So this 10% will not appear in the books. Net of 10%, that is 10% equal to 30. 300 minus 30, that is 270. So while recording the transaction, we will enter the value of 270 only, not 300. Net of trade discount will be recorded in the books of accounts. So the trade discount will, so simple, trade discount will offer on the, it is a reduction in the list price or catalog price, and this trade discount will not appear, will not show separately in the books of accounts. And what is cash discount? Cash discount is also by the supplier of goods or by the provider of services to the buyer from the invoice price, and this discount is allowed as an incentive for paying the bills within a specified time. For example, I purchased goods from the supplier, and the supplier allowed me some time period, and I paid the cash, I cleared the bills within the due date. So as a token of gift, they offered some discount to us on the invoice price. That is called as cash discount, and this cash discount will be shown and will appear in the books of accounts. Generally, this cash discount will be given allowed in this terminology: 2 over 10 net of 30, or 2% net of 10 days net of 30. Like this is the terminology used in for the cash discount. That means the buyer has an option to avail 2% cash discount from the invoice price if the payment is made within 10 days of receiving the invoice. So if we will make the payment within 10 days, of the receiving invoice, then there is a possibility to get the cash discount of 2% on the invoice price. If the cash discount availed, then you have to pay the amount within 30 days. That means actually the time period allowed to us is 30 days, but if you paid before 30 days, that means if you paid within 10 days, then there is a chance to avail to get a discount of 2%. This cash discount is allowed by the supplier on the invoice price in order to encourage the buyers to paid within a specified time, to paid promptly before the due date. So these are the two types of discount: trade discount and cash discount. Trade discount is allowed by the supplier on the catalog price or listed price, and it will not appear in the books of accounts. Cash discount is allowed by the supplier on invoice price, and it will appear in the books of accounts if you availed. This is the difference between the trade discount and cash discount. And another question is, explain outstanding expenses and prepaid expenses along with journal entry. Outstanding expenses which are incurred during an accounting period but not paid, but due to be paid, but not paid within the accounting period due to some reason, are called as outstanding expenses. The expenses which are incurred in an accounting period but not paid within that accounting period, they called as outstanding expenses. That means the expenses which are due, not paid, yet to pay, they called as outstanding expenses. Examples are outstanding salary, outstanding rent, etc. As I told before, this outstanding expenses represent personal account. Will come under personal account. Which type of person? Representative personal account. Outstanding rent, outstanding salary, salary is due, salary is not paid. Paid, not paid to whom? Not paid to employees. Here employee is a person and not an individual, a natural person. So here salary is due to a person, not paid to a person. It is indirectly representing a person, that is representative personal account. It will come under the personal account. So the rule of the journal entry expenses, outstanding expenses is expenses account is debit and outstanding expenses account is credit. For example, outstanding rent, then rent account is debit, outstanding rent account is credit. For example, salaries is due, salaries are not paid, outstanding salaries. So salaries account is debit, outstanding salaries account is credit. So in simple, outstanding expenses means expenses which are incurred during a financial year, during a accounting period, but which are not paid in that accounting period, which are not paid by the end of the financial year, which are not paid by the end of the accounting period, which are still due, which are still yet to pay. They are called as outstanding expenses, and they'll come under a category of personal account. Under personal account, they represent representative personal account. And the other opposite category is prepaid expenses. Expenses which are paid in advance, but the benefit is not consumed within the same accounting period are called as prepaid expenses. Expenses which are paid in a particular during accounting period, but the benefit of that expenditure is not consumed in that accounting period, they called as prepaid expenses. The benefit of expenditure is still carry forward to the next accounting period. The benefit of expenses is still not incurred. The benefit may be received in the next accounting period. They are called as prepaid expenses. Example, prepaid salaries, prepaid rent, prepaid insurance, etc. This prepaid is also called as, another word for prepaid is unexpired expenses. And they also represent a personal account only. Under personal account, which type of person? Representative person. Because prepaid salary paid in advance. To whom you paid? Salary is paid in advance to the employee. Employee is a here person, natural person. So this prepaid expenses will come under the personal account and indicating the representative personal account. So what is the journal entry for that one? Journal entry is prepaid expenses account debit and expenses account will be credit. For example, salaries are prepaid, paid in advance, prepaid salaries. So prepaid salaries account will be debited and salary account will be credited. And where they will appear, this outstanding expenses are shown on the liability side of the balance sheet, and prepaid expenses are appeared and shown on the asset side of the balance sheet. So the expenses which are not paid during which are incurred but not paid during accounting period are called as outstanding expenses, and they are considered as shown as a liability in the balance sheet. And prepaid expenses, the benefit of which is not incurred, not received, but they are paid in the accounting period. They paid in advance. The benefit is still not received. Benefit may be the future. Benefit may be received in future, but they paid in the current financial year. Paid in advance. That is called as prepaid expenses, and they will be shown as they will appear as a asset side of the balance sheet. So this is the difference between the outstanding expenses and prepaid expenses. I hope you understand this one. And next to another question is regarding income, accrued income and income received in advance. Accrued income, actually the income which is outstanding, that means the income is earned during a accounting year but it is not received, still due, yet to receive. The income which is earned but not received, income which is earned in an accounting period but not received by the end of the accounting period are called as accrued incomes. And this accrued incomes also represent a personal account and they will appear on the asset side of the balance sheet. The journal entry for accrued income is accrued income account debit and the income account is credit. For example, accrued interest. Am I right? Accrued interest. Interest earned but not received. In that particular accounting period, you earned the interest, but the amount is still not received, due, accrued, outstanding. It is called as accrued interest income, accrued interest. So here accrued interest account will be debit and interest account will be credit. Example is dividend, accrued dividend. Dividend is earned but still not received. Earned in a particular accounting period but still not received. So it is called as accrued income, accrued dividend income, earned but not received. So accrued dividend account is debit and dividend account is credit. The another type of income is income received in advance. Income earned in advance, received in advance is also called as unearned income. That means the income which has been received in advance, the income which is related to the next future accounting period is received in the current accounting period. That means it is not related to current accounting period. It is related to the next future accounting period but received in the current accounting period. That is called as income received in advance. The income which is received in a particular accounting period but not related to this accounting period is called as income received in advance. This income belongs to a future accounting period, generally the next accounting period, but the payment is received in the current accounting period. Already you received, but it is not belongs to this accounting period. That is called as income received in advance. Income received in advance. So this income received in advance will be shown on the liability side of the balance sheet. It also represents a personal account and it will appear on the liability side of the balance sheet. Why? Because it is not belonging to this current accounting period, current financial year. That's why it has to be shown as a liability side of the balance sheet. The journal entry is, for example, income account is debit, income received in advance is credit. Another example, commission received in advance. Commission received in advance. That means commission related to future accounting period is received in the current accounting period. This is not belongs to current accounting period. This is belongs to future accounting period, but you received in the current accounting period. So that's why it is called as a liability for the company. It is shown on the liability side of the balance sheet. So the entry is commission account is debit. Commission account is debit and commission received in advance. Commission received in advance account will be credit. So these are the two types of the incomes: accrued income and income received in advance. Accrued income is a asset. Income received in advance is a liability for the business enterprise. And next one, another important point is fictitious asset. What are the fictitious assets? Actually, assets means we know fixed assets, current assets, intangible assets. But another category of the assets is fictitious assets. Fictitious assets are the unreal assets, the assets which are not real. Actually, they are not real assets. We call them as a unreal assets. And because of this some adjustment, accounting adjustment, they will appear as a asset side of the balance sheet. They shown as assets in the balance sheet of the financial statement. They are not actually assets. Frankly speaking, they are the losses, they are the expenses. They are the expenses and losses because of some reason not written off, not written off during an accounting period, but carried forward to the next accounting periods. That is called as fictitious assets. So these fictitious assets are the written off against the firm's earning in more than one accounting period. These are actually the expenses and losses which are not written off in the one current accounting period. They will be written off over a period of accounting years, over a accounting periods. That is called as fictitious asset. Example are promotional expenses of a business, preliminary expenses, discount shares, issue of shares, loss incurred on issue of debentures. These are the expenses or losses, and these amounts, this total amount will not be shown in the profit and loss account. They are written off. They are written off over financial years, over a period of financial years, written off over a period. So every year a particular amount will be written off. So that annual amount, yearly amount will be appear in the income statement, and the remaining amount which is still to be written off, the balance to be written off, will be shown on the asset side of the balance sheet. So they are not real assets, they are unreal. That the expense and losses to be written off, and they are shown as a asset side of the balance sheet because the benefit is received, the benefit is still in the next accounting period also. So fictitious assets are the unreal assets, are not real. These are the appeared on the asset side of the balance sheet, and these are the expenses and losses which are not written off during an accounting period, and they are written off over accounting periods, over a period of financial years. Preliminary expenses, promotional expenses are examples of the fictitious assets. And another question is, what is compound journal entry? Normally, whenever a financial transaction takes place, you will record them in a book of called journal. So whatever recorded is called as journal entry. So if you see a journal entry, normally generally a simple journal entry will have only two accounts. One account will be debit, another account will be credit. A simple journal entry, normally a journal entry will have only two accounts. But if a transaction is having more than two accounts, then it is called as compound journal entry. The entry which has more than an account, more than two accounts, that is called as compound journal entry. Either it may be a debit or maybe credit, maybe two debits or maybe two credits, like that. For example, see here, 9,500 received full final settlement of the account worth of 10,000 real, 10,000 rupees by the Unreal Private Limited. So actual due is total amount due is 10,000 rupees and we received 9,500 as a final settlement. So still what happened to the balance 500? The 500 is discount allowed. So here the three accounts are cash account and Unreal Private Limited account, and one more, the final balance is discount allowed account, discount allowed. So in this journal entry there are total three accounts. Two accounts are debit, one account is credit. Cash account debit 9,500, discount allowed account debit 500, and total credit to the Unreal Private Limited company account 10,000 credit. So if a journal entry is having more than two accounts, that may be two debits or two credits, more than two, then it is called as compound journal entry. Compound journal entry. So these are the various types of the important terminology, important accounting and finance questions they asked in the various accounting and finance jobs from the multinational companies, BPOs, KPOs, many accounting and finance related jobs. Still many are there. I'm planning to explain, I'm doing research more than 100 questions, and in this video I covered 10 important questions of various important accounting and financial terminology. I hope this will be useful for you. If this if this information is useful for you, please subscribe to my channel and share to all your friends in the accounting and finance. I hope definitely this will be useful for the students in the field of accounting and finance at their interviews. Thank you. Have a good day.